Hello, and welcome to the Alpha Bureau. Today we're diving into Turkey's massive rare earth discovery and why the market got it completely wrong. We're talking about a 694 million ton deposit that caused panic selling in the wrong companies. The real story here isn't about mining at all, it's about technology, bottlenecks, and where the true investment opportunity lies. Hit that subscribe button and smash the like if you want more contrarian investment analysis like this.
This is such a fascinating case of market misunderstanding.
Let's start with the big picture. For over a century, global power was written in oil. The flow of crude from the Middle East dictated alliances, fueled economies, and sparked conflicts. But today, the game has completely changed. The new great game isn't fought with oil anymore, it's fought with rare earth elements. These 17 obscure metallic elements have become the invisible engines of modern life.
It's amazing how something most people have never heard of has become so critical.
Exactly. Rare earth elements are the essential vitamins of our technological age. They're in everything from the powerful permanent magnets that drive electric motors in Teslas to the phosphorus creating vibrant colors on your iPhone screen. From F-35 fighter jet guidance systems to massive wind turbines capturing energy, our REEs are irreplaceable. Without elements like neodymium, praseodymium, dysprosium, and terbium, the modern economy would literally grind to a halt. This has transformed these minerals from a niche industrial input into a potent geopolitical lever.
So control over the REE supply chain is basically a proxy for technological supremacy and military dominance.
Precisely. And that brings us to Turkey's bombshell announcement. In late 2025, Turkey declared they discovered a staggering 694 million metric tons of rare earth ore in the Beylikova district. This single figure immediately catapulted Turkey onto the global stage as a near peer to China's Bayan-Obo deposit, which holds around 800 million tons. President Erdogan wasted no time declaring Turkey's ambition to become one of the world's top 5 REE producers.
That number is just mind-blowing, almost as large as China's biggest deposit.
The market's reaction was swift and brutal. Lynas Rare Earths, the largest producer outside China, saw its shares plunge 6% on the news. MP Materials, the only active rare earth mine in the United States, experienced significant selling pressure as well. The logic seemed simple. Massive new supply means lower prices, which means compressed margins for existing producers. This was a classic knee-jerk reaction.
It sounds like investors just saw the headline number and panicked.
That's exactly what happened. You can see the damage on Lynas's chart during the announcement period. The sell-off was significant enough to threaten a break below key support levels. Investors remembered a similar event in April 2021 when Lynas fell 15% after reports that Chinese producers planned to double their output. That memory fueled the selling.
So history was repeating itself in investors' minds.
But here's what they missed. To understand why this reaction was wrong, you need to understand China's absolute stranglehold on the rare earth supply chain. China controls approximately 70% of global mining, but that's just the beginning. In the midstream processing stage, where mixed rare earth concentrates are separated into high-purity individual elements, China accounts for an estimated 90% of global capacity. And in magnet manufacturing, again 90% market share.
Wow, so China dominates every single stage of the process.
Look at the production numbers from 2024. China produced approximately 270,000 metric tons of rare earth oxide, nearly 70% of the global total of 390,000 tons. The United States produced just 45,000 tons. Myanmar, Australia, and other countries combined barely make a dent. This dominance isn't an accident of geology, it's the result of a decades-long strategic decision by Western companies to offshore the difficult and polluting aspects of the REE value chain.
So the West essentially handed China this monopoly.
Yes, and that brings us to what I call the Great Deception. The market made a colossal error by confusing ore with oxide. This is the critical distinction everyone missed. The value of a mineral reserve isn't determined by total rock volume, it's determined by the concentration or grade of desired elements within that rock. For rare earth deposits, the key metric is total rare earth oxide percentage.
So that 694 million ton number is actually misleading?
Let me show you the math. Turkish officials stated the Beylikova deposit has a grade of greater than 1% rare earth oxide. Let's be generous and assume 1.5% average. Take 694 million tons times 0.015, that gives you 10.4 million tons of actual rare earth oxide content. This is a world-class deposit, absolutely, but it's not the near peer to China that the headline implied.
That's a huge difference from what the initial number suggested.
Exactly. The proper comparison isn't 694 million tons of Turkish ore versus 800 million tons of Chinese ore. It's roughly 10.4 million tons of Turkish Rio versus China's 44 million tons of Rio reserves. Suddenly, Turkey's discovery represents about 24% of China's stated reserves. Still a geopolitically seismic event, but not the market-flooding cataclysm the market feared.
So it's significant, but not nearly as overwhelming as people thought.
And here's the real kicker, what I call the alchemist's curse. The great secret of the rare earth industry is that finding the elements is easy. The true challenge is separating them from each other. This is where China's dominance is most absolute, and it represents a technical, financial, and environmental barrier so formidable that Turkey's 694 million tons of rock are, for the foreseeable future, just rock.
So mining the ore is straightforward, but processing it is incredibly difficult?
Look at this value chain table. In the upstream mining and beneficiation stage, technical complexity is moderate and China has about 70% market share. But in midstream separation and refining, technical complexity is very high, capital intensity is very high, and China has 90% market share. The key challenge here is complex chemistry, creating massive toxic and radioactive waste streams. Downstream in alloying and magnet manufacturing, China again holds 90%.
So the real bottleneck is that middle processing stage.
Precisely. Mining at Balakova is relatively straightforward, standard open-pit techniques to extract ore, followed by beneficiation to produce a mixed rare earth concentrate. This increases REE concentration from the initial 1.5% to perhaps 40 to 60%. But this concentrate is still a low-value intermediate product, a jumble of 17 chemically almost identical elements locked together. The next step, separation and refining, requires a highly complex process called solvent extraction.
And that's where things get really difficult.
Yes. An industrial-scale separation facility requires massive capital investment. Estimates for a plant in Turkey run as high as $2 to $3 billion. For comparison, the Cave Shell project in Greenland had a projected capital cost of $1.36 billion a decade ago. And the environmental liabilities are even more daunting. For every ton of finished rare earth oxide, the process can generate up to 2,000 tons of toxic waste, including wastewater contaminated with acids and heavy metals, harmful waste gas, and radioactive residue.
That's an enormous amount of waste, and it includes radioactive material?
Yes, and this is where geopolitics gets fascinating. Turkey initially tried to develop this with China and Russia. A memorandum of understanding was signed with China back in October 2024, but these negotiations hit a fundamental impasse. Both Beijing and Moscow wanted access to the raw ore, but they refused to meet Turkey's core demand: the transfer of advanced processing technology and establishment of refining capacity on Turkish soil. China insisted that refining be done in China, which would have relegated Turkey to a low-margin raw material supplier.
So Turkey refused to be just a supplier of raw materials.
Exactly. That's what I call the Erdogan gambit. Faced with this deadlock, Turkey executed a strategic pivot by publicly announcing the full scale of the discovery and opening talks with the United States and Western partners like Canada and Switzerland. Ankara transformed this from a bilateral commercial project into a potential solution for the West's most pressing strategic vulnerability. The real bottleneck here isn't mining, its technology, and Turkey is leveraging the West's desperation to get what China wouldn't provide: capital, partnership, and most critically, advanced technology.
So Turkey is forcing the West to bring better technology to the table.
Precisely, and that's why the investment opportunity emerges. Look at this processing technology comparison table. Conventional solvent extraction, what China uses, is proven at commercial scale but environmentally hazardous, has high capital and operating costs, and requires a large footprint. But chromatography-based separation, developed by companies like REE Element Technologies, is commercially operational, cleaner, has a smaller footprint, and is modular and feedstock flexible. There's also MOF-based recycling and protein binding technologies in earlier stages.
So there are cleaner, more efficient alternatives to China's methods?
Yes, and this is critical. REE Element Technologies, a subsidiary of American Resources Corporation, has developed a continuous ion exchange and chromatography process. They claim their modular system achieves 99.5 to 99.99% purity with 75% less energy consumption, 25% less water usage, and an 80% reduction in waste generation compared to conventional solvent extraction. Crucially, they operate a commercial-scale refining facility in Noblesville, Indiana. This makes them one of the few companies with proven, operational, non-Chinese separation technology.
So they're perfectly positioned to partner on a project like Turkey's?
Exactly. This brings us to our three investment theses, each with different risk-return profiles. First is the bedrock diversified mining majors with lower risk. Second is the contra-Ryan rebound established Western processors with medium risk. Third is the high-alpha arbitrage disruptive technology providers with higher risk but potentially transformative returns.
So investors can choose based on their risk tolerance.
For conservative investors, Thesis 1 focuses on diversified mining majors like Rio Tinto and BHP Group. These giants have market caps of $115.6 and $145.1 billion respectively. They have the balance sheets, technical expertise, and political clout to navigate large-scale resource development. While not pure plays on REEs, they're pivoting toward future-facing commodities and are the most likely candidates to be brought in as major partners on a project the scale of Balakova.
So these offer stability and exposure to the broader critical minerals theme.
Thesis 2 is the contrarian rebound play. MP Materials and Lena's Rare Earths were punished by the news, but they are the only two entities outside China with significant operational experience in separating and refining rare earths at scale. Their intellectual property and operational know-how are immensely valuable and scarce. As the West scrambles to build a new supply chain, these companies are the most logical partners, consultants, or acquisition targets. The recent sell-off presents a potential entry point.
So the market punished the exact companies that have the expertise the West needs?
Precisely, and that brings us to Thesis 3, the highest potential return play. This is American Resources Corporation, trading under ticker AREC, with a market cap of just $320 million. Through REE Element Technologies, they possess commercially operational, clear, and more efficient technology than conventional solvent extraction. A partnership to license their technology or build a facility for the Turkish project would be transformative for this company. Also worth watching is Ucore Rare Metals developing their rapid SX technology.
So this is the pure technology play with the highest upside?
Yes, and you can see the different risk profiles in the financial metrics. Rio Tinto has a market cap of $115.6 billion, a P/E ratio of 11.5, and a price-to-book ratio of 2.0. BHP is similar with $145.1 billion market cap. MP Materials has an $11.5 billion market cap, but a very high PE of 541 due to recent earnings compression, with a price-to-book of 10.5. ACK has just a $320 million market cap with a PE of 28.8.
So the valuation metrics really reflect those different risk levels.
This scatter plot shows profitability versus valuation across the mining and materials sector. We're plotting return on equity against price-to-book ratio, with bubble size representing market cap. Companies in the low right quadrant, high ROE and low price-to-book, are potentially undervalued. You can see AREC has a high ROE of 49.9% despite its accounting complexities, hinting at a highly profitable underlying business model if its technology gains widespread adoption.
So there's real asymmetry in these valuations.
But we need to be clear-eyed about risks. Geopolitically, Turkey is a complex and often volatile actor. Power is highly concentrated in the executive branch and policy can be unpredictable. Technologically, scaling new processing systems to handle hundreds of thousands of tons annually is non-trivial. And market-wise, REE prices are notoriously volatile. A 2018 study showed that at 2016 price levels, virtually no new non-Chinese REE projects were economically viable.
So there are real risks at multiple levels here.
That's why we propose a blended allocation strategy structured as a pyramid. The base, 50 to 60%, goes to diversified majors like Rio Tinto or BHP for stable, low-risk exposure. The middle, 30 to 40%, goes to established Western processors like MP Materials as a contrarian bet. The apex, just 5 to 10%, goes to high-alpha technology providers like AREC as a speculative position with highest risk and highest potential return.
So you're balancing risk across different parts of the value chain.
Here's the bottom line. The market is fixated on the mine, on that 694 million ton number. But smart money will focus on the technology. The winners of this new great game won't be those who simply own the reserves, but those who own the intellectual property and industrial know-how to transform them into the magnets and metals that will build the 21st century.
So it's not about who digs up the rocks, but who can process them efficiently.
Exactly. To summarize, Turkey's 694 million ton discovery is not a simple mining story, it's a geopolitical catalyst forcing the creation of an entirely new supply chain. The real bottleneck is processing technology, where China holds 90% market share, and our three investment theses target different risk-return profiles depending on your appetite. The market punished the wrong companies because it failed to understand where the true value lies.
This is such a clear example of market inefficiency.
Thanks for watching the Alpha Bureau. If you found this analysis valuable, make sure to subscribe and hit the notification bell. See you in the next one.